Yes, question 5. Question 5. We are moving to question 5. Right. Question 5 starts by reading. Enumerate 6 reasons. Enumerate 6 reasons for preparing a cash flow statement in a business. Enumerate 6 reasons for preparing a cash flow statement in a business. We say that a cash flow statement is one key financial statement that shows the flow of money between the money that flows into the business as cash inflows versus the money that flows out of the business as cash outflows. So when you prepare, when we looked at and we said that from a previous question that there are 3 things that we look at when we prepare the cash flow statement. We look at the things that either bring money into the business or take out money. We look at cash flow from the operating activities. We then prepare cash flow from investing activities, and then we prepare the cash flow from the financing activities. So basically the cash flow statement just basically looks at the flow of money between the money that is coming in and the money that is going out of the business. So a cash flow statement is one of the key financial statements of a business that shows movement of cash in and out of the business during specific period. It can be monthly, quarterly, or even annually. So it helps reveal how a company generates and uses cash through its operating, investing, and financing activities. So the main goal is to provide a clear picture of the business liquidity and how much actual cash is available to fund the operations, pay debts, and even invest in growth. So when you look at the reasons for preparing these cash flow statements business, first, it helps to monitor liquidity. It means that it gives a clear viewpoint of how much cash the business actually has at hand at a given time. So unlike the income statement, which includes the non-cash items like depreciation, the cash flow statement focuses solely on real cash transactions. This is going to help the business owners in terms of ensuring that they have enough cash to pay debts, they have enough cash to deal with the day-to-day expenditures or expenses such as salaries, rent, utilities, and other supplier payments. So good liquidity means that the business can operate smoothly without having to borrow or even to delay payments. Secondly, it helps to assess cash management efficiency. Now, when you talk about helping to manage cash management efficiency, a business can be profitable on paper, but still due to poor cash management, but still struggle due to poor cash management. So you are a profitable business, but at the same time you are having problems in terms of cash flows. So the cash flow statement highlights how well a business is controlling its cash inflows and the outflows. So sometimes you are a profitable business making, but you are struggling in paying rent, paying salaries and stuff like that. So it reveals whether cash is being used efficiently. For example, whether too much is tied up in the inventory or receivables. Efficient cash management means that the business collecting money quickly from customers, managing expenses wisely, and of course even maintaining the health cash balance of the operations and even emergencies. Thirdly, it helps to support financial planning and decision making. So accurate cash flow statements help in forecasting future cash needs. So enabling the business owners to plan for for both short-term and even long-term activities. For example, if the business is expecting cash or a cash surplus, it might decide to expand its investment to new equipment, or on the other hand, if there's a shortfall is predicted, the business can arrange for financing or reducing expenses, which becomes like a strategic decision making that depends on that cash flow statement. Next is it helps to evaluate operational performance, which means that the cash flow from operating activities reflects a true financial performance of the core business operations, so without being affected by external financing or investment sales. So if a company is consistently generating positive operating cash flow, it means that the business is healthy, healthy-wise financially, and self-sustaining. On the other hand, negative operating cash flow might indicate that issues like weak sales or even high operating cost, even if the company shows a net profit or the income statement. The objective number 5 is to identify cash flow problems earlier. So regular cash flow analysis helps to identify the cash flow problems earlier enough before they become serious. For example, a business might be making good sales, but if customers delay payments, cash flow could become strained. So a cash flow statement reveals such timing mismatches and cash and can show signs of increased borrowing, high loan repayment, or even investment, all of which can affect the stability. So catching this problem earlier allows the business to take corrective action, such as tightening credit policies and even renegotiating supplier terms. So in a situation we are making more sales, but most of the sales are being most of the buyers are debtors, so you find that you're having so much debts compared to the cash received in terms of the sales. Then lastly is for the purpose to attract investors or secure loans. So lenders or investors always want to see a business's cash flow statement before providing funding. So they use it to determine whether the business can be able to repay the debts on time and maintain operations without relying solely on the external financing. So a strong positive cash flow indicates that the business is not only profitable but also financially stable. So like for example, if a business goes to ask for a loan, one of the requirements that it will ask to represent as a document is the bank statement. So the bank statement basically clearly states the cash flow of the business, because the bank statement captures information about the money that is deposited to the bank account for the business and the money that is withdrawn from the business account. So you'll find that the bank is not interested in terms of the balance. You can have 1 million shillings and you can be denied a loan of 1 million because the bank says that 1 million is there, but in the whole month you have never transacted. There's no money coming in. So in other words, what if the 1 million was strategically put there? Once you get the loan, the 1 million is withdrawn. So the bank focuses on the transactions, how much money is coming in vis-a-vis how much money, the lenders, not the bank, how much money is going out of your bank account. So from that transaction, we are able to see whether your business has the ability to repay the debt or not. So those are the objectives of the cash flow statement that we make. Let's look at the second part B. The following trial balance was extracted from the books of Venus Limited, which is a manufacturing company, as at 31st August 2024. So you can, just like the other one, allow me to, if it's possible, to put this in a table so that it can be easier for us to navigate through. Okay, no problem. It can be like that. So we have the ordinary share capital, retained earning as that, share premium, bank, factory building, and land we have there, plant and machinery. So we have all that information, furniture fitting and all that, accumulated depreciation, inventory. I think you can be able to see we have all that information. There's no need of me going through each one by one. You can see them. Now we have additional information. Now in the additional information, we are told that depreciation is provided on the following rates. Factory building is 4% on a straight basis or straight line basis. Plant and machinery is 20% on reducing balance. Furniture and fitting is 12.5% on a straight line basis. And then of course there's this additional information here where we are told that furniture and fitting are purely for office use. Then additional information number 2, inventory as at that 1st August 2024, we have just a minute. Okay, let me put that. We have finished the goods. We have inventory as that first good. For raw materials, we have 30 million. Work in progress 56,500,000. Then finished good, we have 600 units. And then we are being told that inventory are sold on the first in, first out basis. Then we were told that number 3, 2,000 units were produced during the year. Then of course, number 4, additional information number 4, allowance for doubtful debts is provided at the rate of 10% for debts between 6 months to 12 months and at the rate of 25% on debts above 12 months. The debtors aging analysis was as below. Look at that. Those are the debtors aging analysis. Goods are transferred to the warehouse at a cost plus 20%. Then we are told electricity, insurance, and maintenance costs are to be maintained, are to be apportioned in the ratio 3:1 between factory and administrative expenses. Required: prepare a manufacturing for the year and a manufacturing account for the year ended that 1st August 2024. Right. So we go on that. And then secondly, we have been told we will prepare a statement of profit and loss account for that period of August on 3rd. I'd prepared it, but I will want us to check on the workings one by one. So we'll start with question 1. That is the manufacturing account. So we have the heading manufacturing account is for the year ended that 1st August 2024. We have that, and then that. So we can extend that down to create more working space. Right, let's start with that. We are going to have our data in let's put them in thousands. So we start with the raw materials. Raw materials. In the raw materials, we start with opening stock. So we'll come and look at the opening stock. We have been told that the inventory as 1st September 2023, the opening stock for raw materials is 55,000. So that is the figure we will take. So opening stock is 55,000. Then now we will add purchases. Okay. We'll come from our laser, we check on purchases. We have our purchases here, purchases and sales. So the purchases are 225,000. So we add 225,000. Then we add, let's see if we have carriage inwards. of course, because it has been debited, we have been told carriage on raw materials. So carriage on raw materials, so we put it as carriage inwards. We add it, that is 7,500. Then we less returns outwards. We less returns outwards. We have been given them. Where are they? From the question. Here they are. Return outwards. We have 5,250. So we less that 5,250. Put it brackets. Then we less closing stock for raw materials. So closing stock for raw materials. From additional information, we have been told that inventory as at 31st August 2024 for raw materials was 30 million. So we have said in thousands, so we'll get less 30,000. So let's add that 55,000 plus 225,000 plus 7,500 equals minus 5,250 minus 30,000. We will get 252,250. So this is what we refer to as cost of raw materials consumed. So cost of raw materials consumed. What we'll do, we will add direct wages. We look at the direct wages. We have been given direct wages, which is 120,000. So we add direct wages, which is 120,000, for us to get the prime cost. So that is 250, that is 273. So 372, 250 is our prime cost. Good. Now let's talk about the factory overheads. I hope you are familiar with the format of preparing the manufacturing account. We did in our previous paper. Factory overheads. Now in the factory overheads, we have been told that electricity, we'll start with electricity on this aspect. Electricity, insurance and maintenance cost are to be apportioned in the ratio of 3:5. So in this factory overheads or expenses, we will give that, we'll go with that ratio. So we have the ratio for electricity, we have the ratio for insurance, and of course we have been told about maintenance and repairs. So the ratio is 3:4 because we have been told 2:1, 3:1, 3:4 times. So we check on our amount on electricity. Electricity is 20,000. Insurance, we'll talk about insurance. Insurance is 24,000, and then maintenance and repairs is 34. So I have that figure. Electricity 20,000, insurance 24, maintenance 34. So we get the electricity 30,000 of 20,000, insurance 3/4 of 24,000, and maintenance 3 over 4 of that 4,000. So if you do that, 3 over 4 times 20, you will get 15,000. Insurance, 3 over 4 times 24,000, you will get 18,000. And then maintenance, three over 4 of that 4,000, you will get 25,500. Then now, the next thing we talk about as part of the overhead, factory overheads. In fact, let me handle this. The next thing we are going to talk about factory overheads will be depreciation. Depreciation. And in terms of depreciation, we have been told depreciation is provided in the following: factory building 4% on a straight line, plant and machinery 20% on reducing balance, furniture and fitting 12.5% on 12.5% on a straight line. But we have been told that furniture and fitting is purely for office use, so it's not part of manufacturing. It's purely for office use. So we will get depreciation for plant and machinery. So we'll have plant. Okay, let me just erase this. So we have plant and machinery. So for plant and machinery, we have been told it's 4% on a straight line. So that is plant and machinery is 4% of. Now look at this. We have been given the information here that plant and machinery, the depreciation for plant and machinery is 20%. Correction. So that is 20% of. Now we have been told that 20% on reducing balance, which means that the depreciation for plant and machinery was 200,000. And we have been told here in our depreciation on the trial balance, we have been given that accumulated depreciation for plant and machinery was 20,000. So it will be the 20% of 200 minus 20 for us to get the accumulated the depreciation for that building, because that is 20% is the one for the future, but so that we are lessing so that we can get the depreciation for that year. So that means that we will get that, then we'll get 200,000 minus this base is limited, minus 20,000. That is going to be 0.2 times times 180,000. If you do that, you're going to you will get that 6,000. So depreciation for plant and machinery will get that 6,000. Now the next one is for factory building. Factory building is the one that we have been given at 4%. So we have factory building. So factory building will be 4% of, into brackets. Now we have been in the factory and building, we have this information. We have been told factory and building, land is 40%. Factory and building was 170, but out of that 175, land is 40%. So let's reduce, let's minus 175 minus 40 million, so that we are able to get the value of the factory building itself. So that will be 175,000 minus 40,000. So if you do that, okay, 175 minus 40 plus 10, so you get times 0.04. You will get the depreciation for that land building only, it's 5,400. 5,400. So according to the in line with the manufacturing, those are the depreciation that we'll deal with. Now our next factory overhead will be the what we have been given right here, factory equipment hire. We have factory equipment hire, which is at 22,500. So we add factory equipment hire, that is at factory equipment hire, which is at 22,500. So we have our total, let's check our, let's calculate our total overhead cost. So we start by 15,000 plus 18,000 plus 25,500 plus 36,000 plus 5,400 plus 22,500. We will get our overhead cost at 122,400. So 122,400. We add the opening work in progress. Opening work in progress. We add opening work in progress. We are told work in progress. The opening is 40,000. That is at September 1st, 2023. So we add 40,000. Then we less closing work in progress. Closing work in progress, we less that. So closing work in progress is at here. Inventory at first payday was work in progress was 56,500. So we less that 56,500. 56,500. We put it into less. So now let's I think I will need some more space here. So let's add, we add 372 to 50 plus 122,400 plus 40,000 minus 56,500. We will get 478 150. 478 150. So 478 150 is the total cost of production for finished goods. Total cost for production for finished goods. So for us to get the profit, we will use the markup. We have been told here, number 5, additional information number 5, goods are transferred to the warehouse at a cost plus of 20%. So the cost plus of 20%, so we add manufacturing profit, which is 20%, that is 20 over 100, times the total cost for production, which is 478 150. So if you had that 20% times 478 150, you will get 95 630. That becomes our manufacturing profit. That is our manufacturing profit. So if we had the total cost of production with the manufacturing profit, we are going to get, we will get 573 780. 573 780. This now becomes what we refer to as finished goods at transfer. Finished goods at transfer. So that is how we prepare our manufacturing account for that year ended in that period. Well prepared? Well prepared. Similar to what we have done. It's well prepared. The calculations are up there as what they are done. Now the next part is to prepare the statement of profit and loss account. Now, for us to prepare the statement, we will we will start with, let's have the title there. Statement of profit or loss account for the year ended that 1st August 2024. So we have that. Okay. So in preparation of the statement of profit account, we have prepared quite a number of them. So I think we are now getting familiar with the format and the type of information that we want to put here. So we'll start with the sales. Now here we will deal with the finished goods, the data of the finished goods from our question. Now I think just like the other question, for this part, allow me to also copy this question down here. so that I don't have to be coming all the way up. Okay, here we are. Now let's look at the cells. Now the cells that we are looking here at are the cells of finished goods. So we have, from the information that we have been given, we have, where are the cells? Well, the cells. Okay. Purchases and sales. So we have the purchases and we have the sales. Sales are 681 500. This is in terms of also zeros. So we have 681 500. So we do not have returns inwards for us to be able to less. So we go direct to the cost of sales. The cost of sales, we start with the opening stock. So we look at the opening stock of finished goods. Now, we have been given finished goods in terms of units. We are being told that finished goods inventory, as we have started, finished good 200,000 units were sold. So the opening stock for the finished goods, the value was 39,000. So it means that we take that figure, 39,000. So we add, now because we add what we call goods transferred from what we calculated, we add goods transfer now. If we come back to our calculations, our goods transferred, we find that finished goods at transfer were 573 780. 573 780. That is the figure that we add to our data. 570, just a minute, 573 780. Those are the figure that we add. Then we less closing stock. Then we less the closing stock. So we less the closing stock. Now what we are going to do here, we have been told finished goods, we have not been given the closing stock, but we have been told finished goods 160 units. We have been given the ones, the finished goods were 160 units, and we have been told inventory are sold in first in, first out basis. So what we are going to do there is that we are going to calculate, let me use this space. We are going to calculate the cost of transferring inventory. We are going to calculate the cost of transferring inventory, which we are going to use as our closing stock. So what you're going to do there, if you have cost per unit using FIFO method, that will be cost of goods transferred, cost of goods transferred divided by the units produced. Right, now we got cost of goods transferred. We got our cost of goods transferred to be 573,780. So it's 573,780 divided by, we have said, the units produced. We have been told that how many units were produced. From the question, we have been told that 2,000 units were produced during the year. That is, 2,000 units were produced during that year. So we are going to divide. So that is 573,780,000 divided by 2 million, because we are told 2 million units were produced during that year. So what you are going to get there, if you do that, let's check. 503. So we are going to get 286.89. 286.89. Let's round off to a whole number. We'll get that 200. The cost per unit was 287. So now we have been given that the inventory, the finished goods, the closing stock for the inventory was 160,000 units. Now let's get the value of the 160,000 units. That will be, or we put that, let me tell you how we name it. Okay, we say cost of transferring inventory equals to the 160 that we are told times 287. So 160 times 287, you will get 45,920,000. So that is the closing stock. So the figure there is what we are going to take as our closing stock, 45,920. So in our closing stock, we less 45,920 because it's in terms of thousands. So if we do that, we'll get, so 39,000 plus 573,780 equals minus 45,920. You will get 566,860. So you less it from the cells 681,500 minus 566,860 equals 114,640. This is the gross profit. This is the gross profit. So we add the manufacturing profit. We add the manufacturing profit. That is the figure that we got from our calculations, the manufacturing profit. That is the figure that we got. Add manufacturing profit, 95,630. 95,630. That is the figure we add there. Manufacturing profit. So we add 95,630. So we get 114,460 plus 95,630. We will get 210,270. Now this becomes the net, the total profit. Sorry, not that profit. So this becomes the total, the net income, not even the total profit. This becomes the net income. Now less expenses. We less the expenses. So we check on the expenses. So we check, we start with the, we have allowance, carriage outside, direct wages, administrative salaries, electricity, maintenance, and all that. So we start with the administrative salaries. We have been given 80,000. The next we have sales and marketing. We can pick an expense, sales and marketing expenses, 13,630. We have electricity. Now, from our additional information, we were being told, like for example, electricity, insurance, and maintenance cost are to be portioned at a ratio of 3:1 between factory and administrative expenses. So we need to calculate, let me create some space here. We need to calculate what you call the, through the ratios, we need to calculate the portion for electricity, insurance, and maintenance costs for us to have, which is part of the general expenses, so that we are going to add it there. So in terms of manufacturing, if you look at in terms of manufacturing, we were given the ratio of 3:4. Okay, that is on electricity, on insurance, and maintenance. We were given 3:4. So times those costs we were given. Electricity is 20,000, insurance 24,000, maintenance was 34. So we already calculated that. I remember we calculated that. We got electricity 20,000, 15, 24, 18, 34, 25, 500. So we have that part whereby we are calculating that electricity in the manufacturing. So electricity is 20,000. So we got 15,000 for electricity, So insurance was 24,000, so we got 18,000 for insurance, and then from maintenance was 34,000, so we got 25,500. So about administrative expenses, the ratio is 3:1. So on this electricity is 1:4, on insurance 1:4, on maintenance 1:4. So 1:4 times 20,000, 1:4 times 24,000, 1:4 times 34,000. So we'll get the ratio for electricity, that is 1 divided by 4 times 20,000. So we'll get that is 5,000. For insurance, that is 1/4 divided by 24,000. You get that is 6,000. Then for maintenance, that is 1 divided by 4 times 34,000. You will get 8,000. So if you add all this, that is 5 plus 6, that makes it 11, right? 11 plus 8, we have 19,000 in terms of administration. Now come here on the question we have been given. From the question we have been told general administrative expenses. General administrative expenses were 46,120. So we add the general administrative expenses to here, to the one for electricity, because we have been told that it was between all that was administrative expenses. So let's generalize it all. So we add the general administrative expenses here are 46,120. So we add 46,120 to this 19. 46,120. So we are going to get 120 and 9 plus 6, that is 15. Carry 1, 4, 5, 6. So we are going to get the total being 6 at a place. Point of correction, kindly remember, because this is 25, I wrongly indicated. Now 1/4 times 34,000 is 8,500, not, I've done these calculations before, so I know what to expect. So that is 19,500. So it should be 65,620. Yeah, that becomes the general administrative expenses. So here in our expenses, after administration salaries, we can add general administrative expenses, which are now coming at 65,620. So we add that. Then we add bank charges. Bank charges are 62.50. So we have bank charges 62.50. Then we add discount allowed. So we are given discount allowed was 91,150. Discount allowed we have 91 sorry, 9150. Then now we have the depreciation, because we were told depreciation for furniture and fitting was for office. So we have depreciation, and for furniture, so the depreciation basically is for furniture and fitting, and that was the depreciation for furniture and fitting was happened at 12.5 on a straight line on where is that depreciation for furniture and fitting, furniture and fitting. Yes, 25,000. So that is depreciation. Furniture and fitting is 120,000. So depreciation for furniture and fitting is according to the question, that is just a minute, that is 12.5 on a straight line. So in our calculation we add that, that is 12.5 over 100 times 120,000. We get 15,000. So that is 15,000. The work looks dirty. That is 15,000. And then of course we will have the unearned profit on the closing stock, that at the unearned profit, because we are being told that the goods transferred to the warehouse at a cost plus of 20%. So the profit after calculations, remember we got the total cost for production on finished good was 478 on that. Now the unearned profit, we are going to get 20%. In our calculations we have gotten on this, we have gotten the cost of transferring inventory was 45,920. That is the the closing stock. So 20% of that closing stock is what we are going to refer to as an unearned profit. So here we are going to have an unearned profit on closing stock, that will be 20% times 45,920. 20% of 45,920. So you will get 9,184. 9,184. Then of course, lastly, we are going to have the increase in allowance for debtors. Increase in allowance for debtors. Now, in the increase in allowance for debtors, we will have to do also some calculations. We have been told from the question that allowance for doubtful debts is provided at the rate of 10% for the debts between 6 months and 12 months. So the debts between 6 months and 12 months, that is 0.8 months. So it's 38,500 plus 6 to 12 months, 45,000. So that will be, let's do that calculation here before we get the figure. So debts for 6 to 12 months is going to be, we have said that 8,500, plus 45,000. So you are going to get these debts 38,500 plus 45,000. You will get 83,500. 83,500. Then we are being told that the allowance for the debts provided at the rate of 10% for the debts between 6 months to 12 months. So that means that the right. So here allowance for these months. So allowance for 6 to 12 months, then that will be 10% times 83,500, which is going to be 8,350. Then we were told that at the rate of 25% for the debts above 12 months. The debts above 12 months are equal to 50,000. So to get that, that will be for above 12 months is going to be 25 over 100 times 50,000. So you are going to get that to be 0 times 5 12,500. So the total will be 8,350 plus 12,500. The total will be 20,850. Then now we have that. Let's get the increase in allowance. What is the increase in allowance? Because we have been told that allowance for doubtful debts was 17,500, and we have calculated our allowance for doubtful debts. We have gotten 20,850. So the increase equals to 20,850 minus, where this is minus that allowance from the allowance for doubtful debts 17,500. So minus 17,500, which is equals to 20,850 minus 17,500, 3,350. So that figure there, 3,350, is what we are going to take as our increase in allowance for debtors. So we added 3,350. So then we add all the expenses. 13,630 plus okay, 13,630 plus 80,000 plus 65,620 plus 6,250 plus 9,150 plus 15,000 plus 9,184 plus 3,350. You will get the total expenses to be 202,184. So we less them from the net income. 210 to 70 minus 202,184. We get our profit to be 8,086. So this is our net profit. So Right, that is how we are able to calculate on that. There's a calculation on this here. So in that question, we were asked about the two. We were asked about preparation of the manufacturing account, of which we have done. Then at the same time, statement of the profit account, of which we have also clearly done. Question 1 was reasons for preparing cash flow, 6 marks, and then the other two questions 6 marks, which makes it 20 marks. But at the same time, for the purpose of probably maybe next time you might be asked to prepare what we call the financial statements. Of course, we are going to engage on that more in the questions to show how you prepare the statement of the financial position. So with that, I hope you enjoyed your class and you followed in terms of what we discussed. Thank you.
So if you like this video, you can always enroll with us. You'll be able to access more of these revision sessions. And also you'll be able to find well done lectures or pre-recorded videos for all the KASNEB courses as well as CHRP. And in case of anything, you can always reach us out. We have our contact details on the screen. Feel free to call, feel free to WhatsApp anytime. So thank you, and let's meet in our next session.